Hello and welcome to Rebank. I'm your host, Will Beeson. Luke Voiles is the CEO of Pipe, an embedded finance platform providing credit, cards, and other products to a range of B2B2B partners. Founded as a revenue-based financing business, Pipe pivoted into a platform business under Luke's direction when he took the reins in 2023. Prior to joining Pipe, Luke was GM of banking at Square and previously head of QuickBooks Capital, Intuit's SMB lending offering. Luke has nearly 10 years of embedded finance experience, especially lending, and has shaped Pipe's offering based on his extensive learnings. In this conversation, Luke and I discuss what makes a good embedded finance offering, the opportunities and challenges in credit, including the economics, cyclicality, and risk management considerations, Pipe's distribution strategy, scaling a fintech platform business internationally, and much more. Thank you very much for joining us today. Please welcome Luke Voiles. Luke Voiles, welcome to Rebank.
Thanks for having me. I'm excited to chat.
Likewise. It's great to connect with you. Big fan of your work at Pipe, and I have a decent sense of your background previously in distressed debt, and then at Intuit with QuickBooks Capital, and then as GM of banking at Square. You're an incredibly accomplished guy, and now you're at the helm of Pipe. Just to kick off, super basic question. How do small businesses bank? And how does that potentially differ from what the average person has in their head in terms of how small businesses bank?
Many of them don't even have a business bank account yet. They're just using their personal account. And so here's two great examples. QuickBooks Self-Employed was created for like the sole prop, like single trader population. That all they needed to do was file a Schedule C and track their business and personal expenses. So they would link in their personal bank account usually. And then this, like Alex Chris, CEO of PayPal now, like he was leading the QuickBooks Self-Employed team, and his team, like he has some of them there at PayPal now, including like John Pasoli. They built this pretty amazing slick product where you just swipe left for business expense and right for personal expense. And then it helped you do taxes and TurboTax with a Schedule C. That's the example of how people do this. They don't have a business bank account. They're using their personal account. Everything's intermingled and it's hard to tell what's going on. And it just takes a ton of time. Just to maximize your deduction for taxes, you got to do a ton of work. And many of them, like, here's the other example. I love these QuickBooks examples. The biggest competitor of QuickBooks is a shoebox full of receipts, right? Many people don't even have the bank data linked in. Like, and you go back to like, I've got all these expenses. I got to like figure out which ones I can use for business expenses. And you get to a spot where, yeah, it can save you a ton of money, but you don't have time because you're trying to feed your kids and you're just stuck behind the scenes. So like, those are the horror stories of how these super small businesses that have a 50,000 in revenue up to maybe $1 million in revenue, you'd be dumbfounded what's going on in the background. Like they have no idea what to do with this stuff. They're just focused on running the business, and their accountant says, "Hey, do you have any expenses I can use at the end of the quarter?" And they're like, "I don't know," right? Like I haven't been tracking it. So those are two good examples. The other example is at Square Checking. Had tons of customers on Square Checking, but the only people who would ever take that bank account are ones that didn't have a bank account yet. Right. So it's when you onboard for payments, it's actually great to be able to offer that bank account at the same time. Like you don't have a business account yet, you should just take this one because it's easy to onboard to, right? Like go. And so there's moments where you can help and it matters. But the reality is if somebody already has a business checking account, they're never going to take Square Checking. Right. And so it's just a timing thing. Right. It's just shoebox full of receipts, maybe a simple app, personal bank accounts, you name it. It's just a tough space for these super small businesses.
So what's the sort of transition from that standard approach to you at Pipe ultimately being able to serve a customer?
I don't think banking should be the thing that leads, right? For me, that's why I believe in embedded financial services so much. The thing that should be leading is what our partners are doing. They are solving the pain points end to end for nail salons or for plumbers and electricians or for restaurants, right? Or for just retail shops or coffee shops or donut shops. There's so many different verticals now. The easiest example that most people know is Toast really focused on restaurants and they started taking customers away from Square. But Square says, oh, I got to do this restaurant product too. And then another vertical pops up and they start taking customers from Square. I got to do another, Square can't do 50 verticals, right? It's just it's a horizontal from my perspective. Same thing for Intuit. Yeah, everybody uses it for accounting, but think about where the business owners are going now, right? They're going into the SaaS vertical software to book their appointments, manage their inventory, take payments, manage their e-commerce store. Everything starts to happen in the vertical software now. That's where the world is moving to. Like the business owners don't go to the banks anymore to deposit checks or to get cash for the next day because it's mostly card transaction now. And so the places where business owners are getting their time saved becomes these SaaS vertical offerings. And so that's the most important thing. They can still use their personal bank account and like have Stripe or Square or whoever deposit the cash, or whoever, if you have a PayFac, if you're one of these verticals, deposit the cash into that outside bank account all the time. That's the secondary thing. Like that problem's already solved in an okay way. But the thing that is really solving the problem for the small business is the SaaS vertical, where it's just magical for you to run that business because it's dialed in for you and exactly what you need for a nail salon or for a restaurant, right? That's where the problems are being solved. That's why I'm so excited about embedding the financial services there as a secondary feature. I don't think the neobank for small business as the lead is just too hard, especially for these micro merchants. Like the business owners want their time saved, and the best way to save their time is with the SaaS vertical software.
Makes sense. Makes sense. So if I then look to characterize the business that you're building now, it's an embedded finance platform that started with a lending product and I believe potentially second product or otherwise in parallel card issuance product. Plugging that into vertical SaaS businesses that are basically providing if it's the example of a gym, it's the sort of class booking, it's the member onboarding, the subscription management, the sort of business admin portal that's specifically designed for that type of business. And then you're basically integrating all of the financial products into that experience. Is that the way to think about it?
Correct. It's white labeled as well, right? So Boulevard offers Boulevard Capital powered by Pipe. And so it's a trusted brand already. And we're working with our partners now to figure out who wants to launch card. And it'll be a full spend management suite, also white labeled for that partner. It's just going to be the best experience that's with the flip of the switch. You can turn on the other features. We want to do embedded payroll one day too, by the way. Like we'll have all of these, and then we will start adding banking features over time, like auto savings for tax. Hey, here's a debit card. If you want to spend your money for free instantly, you can use that, right? And then once you have card spend, bill pay spend, and payroll, that's most of the expenses for most of these businesses, right? And so then you start to say, okay, maybe I could switch from Bank of America to this bank because all my spend is happening here. And that's the thing that ties you into your bank, is that you're spending stuff out of that bank account. It's just too much work to change it. And so, yes, it's number one, pain point capital, and then spend management and bill pay. Then all the rest of the financial services features are coming too. And it's going to be where the SaaS vertical platform can focus on the customer pain points. They don't have to worry about the regulatory risk and the credit risk of moving all this money and taking all this risk. Pipe handles all of that. And we share back almost 25% of the revenue with the partner. So they just get 5 extra points at EBITDA without taking much risk, right? So it just makes a ton of sense. The customers are there already. They're getting served where they are every day. They don't have to go anywhere else. They're seeing the offers. They can manage everything. It just becomes the management suite within whatever vertical there is. For each of these platforms to build this themselves, we have a 130-person team now, right? It's very, very difficult to build a scalable capital business. That's the hardest thing to build. That's why we started there. Yes, you can monetize and make money doing it too, and that helps pay the bills, but I wouldn't recommend anyone that's got less than 100 billion in payments volume try to do this themselves. And even then, you got to hire a 50-person team to make it happen.
So your capital business, it's differentiated from traditional lending because it's based on transactions, right? It's like revenue-based lending, right? Payments-based lending for the business as opposed to some sort of other approach to underwriting. Is that right?
That's correct. I think the simplest way to describe that one is imagine a coffee shop that sells 1,000 coffees a day. And they have one POS terminal in that location, but that may only be 50% of their revenue. They may have an online store, they may have other stuff. But when you look at the data from that POS terminal, you have perfect data on one part of their revenue, right? And so what we've done is you narrow the risk problem to that single POS terminal. With 6 months of history, you can very accurately predict what the next 12 months is. So assume that coffee shop's going to make $1 million. You can advance them 100,000. Right? And then you get paid back by holding 10% of every day's transactions over the next year until you're paid back, right? So you're structurally senior from a cash flow perspective. You have perfect data. And so it just narrows that risk problem. So because of all that narrowing, we don't have to ask for FICO. We don't have to ask for bank data. We don't have to ask for commercial or consumer bureau. We're really only underwriting based on the historical transactions in that POS terminal. So narrowing the problem, structural seniority, the risk is so good, you can just originate stuff in the morning and sell it in the afternoon to capital markets buyers, and you have a balance sheet light setup. Right? It's the only small business lending product that you can really do that on. The product we did it into it, we had to understand all of the expenses too. And then it gets super complicated. We did it because we had 36 billion accounting transactions and 36 billion bank transactions, and we could actually solve and figure it out. But there's very few people or businesses that have that much data on small business. Even at Square, we only use the credit card transaction history. Like that's why it's such a 4-click magical experience, because there's no friction. It's just like, here it is. Do you think it's interesting? Yes. I agree to share my data with Pipe. Okay, here's the offer. Okay, like I'd like to go. Like that's it. And because it's all automated, we have the data in the background, right? It's pretty magical. Like that's the core product. And like embedding that, solving the number one pain point is the leader. Like that is our wedge to get access to pay the bills, solve the number one pain point for small business, pay our bills, and get us access to data for our other AI stuff we want to do later. And I can talk about that later.
So embedded finance has been a potentially exciting space for some number of years now. I think it was largely hypothetical in the pre-2020, maybe. There were people focused on it from a sort of payments standpoint. There were certainly the likes of what you guys were doing at Square and many others. Banking as a service was really taking shape as a vertical within fintech. And a lot of the driver or the perceived opportunity around banking as a service was, hey, we can build great software middleware on top of legacy banking infrastructure, and that will allow us to deliver financial products like exactly where and exactly when they should be surfaced. You have all these platforms, whether they're scaled internet companies or e-commerce companies or whatever else, and there's an opportunity to sell a credit card or to sell insurance or to sell a payment, whatever it is, say at the point of checkout or at the point of onboarding, at the point of confirmation of whatever the main experience is. And we think we can package and deliver a financial product at the same time, and it's going to be a lower cost of acquisition. We're going to have a higher conversion rate. And because we can deliver this horizontally across platforms, we'll be able to do this in a capital efficient way. If that was, say, the sort of like 2018, 2019 thesis around embedded finance, you've been building in this space now for many, many years. How would you update that thesis? What have we, as an industry learned over the intervening years? How would you kind of sharpen the focus of what I just said?
I think like maybe talking about what people tried and didn't work is a good example, right? A lot of these neobanks, and you talk about consumer and small business, this applies to both of them. It's just even harder in small business. They all thought they could just monetize with interchange, right? I'm going to issue a debit card. I'm going to have a FBO wallet. I'm going to have these other nice features to help like be a personal finance management tool or something. And I'll make all my money on interchange. What it turns out is it's so highly regulated and it's so complicated to move all this money. Like 1% on every transaction is not enough to monetize a business. Look at banks. 80% of the revenue is capital and risk, right? You have to take the risk to make the money. And so you have a whole generation of neobanks, most of which are not doing great, right? Because they never figured out credit, right? And that's the core thing. I think Nubank might be the only one that has actually figured out credit and is just dominating because of it. Revolut, somewhat, yes, but almost nobody else has been able to figure it out very well. They all try to do a term, that's on the consumer side even. Like Chime, 2-day early access, that's great. And they're all trying to do some type of early wage access now. And maybe that's enough, maybe it's not. But nobody's really figured out how to actually monetize in an embedded way with capital. And so I think that was the mistake. People just didn't realize how important that credit part was. And that's part of the reason why Pipe started there. You make a lot more revenue when you take the risk. And it's just so hard. And the VC investors don't love it because there's so many examples of people screwing it up. I mean, I was a distressed investor for a decade. And all I did was buy loans from people who screwed it up, right? Either like structurally or because the market turned so bad on them. But like, there's just so many ways to mess it up that people are just a little afraid of the credit risk. The reality is, like, in order to win, you actually have to be really good at that part and execute perfectly on that part. And then everything else comes along behind it. And so I think that's what was just missed. Everybody thought, oh yeah, like we can do neobanking. You can embed wallets. Everybody's going to want to use my wallet. It's like, no, the business owner doesn't care about your wallet. You can't make them open that wallet or use it. Like PayPal even can't get people to leave the money in their FBO because they just already have a bank, right? And so like there's just a misnomer of like, you talk to an old grizzled banking veteran, he'd say that she would say it would take $5,000 to convert a small business customer over, and you may not keep them, right? You give them a bunch of money, you'll figure out how to transition them in, but you have to give them that much to take the pain to switch over. And so I think there's just so many assumptions about, we can get people to sign up. Yeah, we can monetize this thing with just debit interchange, or we can charge a SaaS fee because they want to do bill pay. Like people are giving that stuff away for free now, right? You don't have to no consumer or micro merchant wants to pay $50 a month for features they can get for free elsewhere, right? So I think there's just a whole bunch of missteps of thinking customers really needed it or wanted it and just go. Some have been successful, up market more. Bluevine does a pretty good job of a better banking experience in the mid market. And it's just a slog to go scale, acquire customer over time. But once you have them, they're sticky. But in this micro merchant space, nobody's figured it out yet. And they all tried to do it in a way that really didn't work from a unit economics perspective because they didn't have capital on the roadmap. By the time they try to bring it in, they try and mess it up or try and mess it up, try and mess it up. I've seen it happen so many times. That I think is the trend that is shifting finally. You have guys like Rex finally post and say, yeah, the money's not in payments, the money's in credit risk. And yeah, but it's really damn hard, right? And so you can do it, but you got to be dang good at it to make it happen, right?
Yeah. Well, I mean, to that point, what was it that allowed you to build a successful credit product? We talked about risk management as being key. I guess there are two parts to the question. Maybe we start with the first one, which is in terms of actually building the operations, the risk management, and the underwriting, what were you able to do where you think others failed? And then maybe we can talk about the capital structure, capital pipeline element of it to follow.
Sure. It was a very unique situation for Pipe. Pipe was able to raise $316 million of equity, right? And then use that to go try to build this thing. A lot of the other startups in the capital or credit space may raise 20. They raise 30 and they start hiring people and they start deploying. You're not going to convince a warehouse lender to give you any money to take credit risk that early. So you have to deploy equity dollars to start testing and growing. And so, but in order to do that, you got to grow slowly. You got to do a little bit of loans, make sure they're working, grow slowly, or you step on the gas from a marketing perspective and it blows up and you're done. And it's always just a fight for life. And so it's so hard to start a capital risk type of business. I would never do it unless there was at least $150 million in the bank account to give you 5 years of runway, to hire the right team, to go build this stuff from scratch, and then sign up big partners and start going big immediately. That was the unique scenario that Pipe had. There was almost $200 million when I got here to start with to go build this embeddable Square Capital, Pipe Capital as a service experience, hired 20-year veterans in every seat. Our chief risk officer was 14 years at Amex, 7 years at Funding Circle. He didn't have specific in the flow of money type risk experience. So as head of credit strategy, we hired underneath him, helped build PayPal working capital's early models. We just cherry picked the best people that we know in the space that we know are good and know can build the right stuff, and then bought the data we needed to actually build the models. That's the core piece, the credit side, simulating the models first based on hundreds of thousands of businesses, 5 years of history of credit card transaction data. You can just dial it in before you make the first advance. We did that at Intuit too. A lot of these startups say, no, I just got to deploy the capital and see what happens. It takes way too long to get to a place that works. You'll have messed up vintages for years as you dial it all in. We bought the data we needed to get to a curve that we knew we wanted to hit, and now we're tracking perfectly to it. It's just a different method. Having the resources allows you to go big like that and buy the data you need and just go and get the right people in their seats to make it happen. And so I think fundamentally we had the resources. We've all been there, done that before on the credit team and on the overall business team. Every single person in my exec team has 20 years of experience doing this stuff. And so we just brought in the right teams underneath them and just started to go, and then convinced partners to let us lend money to or advance capital to their customers. I've seen lots of small ones try to get started and any mess up at all and you can't raise and you're done. But to have a war chest as big as what we had at Pipe to go, that's the reason why I took the job. Yeah, we can make it happen. We have 5 years to figure it out. That's plenty with the right team.
Can you talk a little bit about at Square? I mean, you were basically processing the payments and providing the credit. And at Pipe, you're not doing that. I don't think you're involved in the payment at all. I think you've done a very elegant job, from what I understand, of kind of creating a sort of FBO account structure where the underlying payments are received, having visibility into the transaction data so you can kind of proxy to all of the same information. But can you talk a little bit about any differences between the business where you own the payments versus don't, and any work that you've done to sort of account for that?
Yeah, I mean, when you're in the flow of money, the risk is better. The business owner, what it does, it actually takes out the moral hazard. The business owner can't choose to not pay you if they're still using Square. There is some evasion where the business owner will say, you know what, I'm canceling my Square account. And then they open another one with their brother-in-law at the same location with the same POS terminal. And you have to reattach the loan to the other one, to the other user. And so people try to evade sometimes, but still being in the flow and being able to hold the payment before the customer gets the money in their bank account takes the moral hazard out. They don't have to decide whether they write you a check to pay down that loan or not. It automatically comes out. Our FBO layer gives us a similar setup. We also can do with pilots just a daily back-to-back ACH, which we have to make it as easy as possible for the partner to test our product. They don't need to split payment. They don't need to do the FBO layer. They don't need to do anything. We just need the data. We have a fully Pipe-hosted experience where the customers, after they see the pre-approved offers from Pipe, will land on the white-labeled Pipe-hosted page. And if they like what they see, they can agree to share their data with Pipe and then go ahead and apply. And it automates everything. So you still have the magical customer experience, but the partner hasn't had to code anything yet. We're just going to get a daily file from them of the money that was put in the settlement account that day. The next day, we'll hold 10% through ACH. That works. It's not ideal. And we like to get our partners to shift toward FBO or to split payment over time because the risk is better. So before we really scale with partners, we want to get closer to that Square-like setup, which is split payment.
So on the other side, right? So if that's the kind of almost like lending operations and some of the product flows, talk to us about the back end of the business, the balance sheet part of the business. So I imagine there is some level of equity that you're allocating against each dollar that you lend, maybe not. Probably there's some sort of trajectory that you're on at the very beginning. Maybe you're allocating more equity against each loan. Maybe there's a North Star end state where you're allocating even less and or zero equity, which allows you to scale at a faster rate. Talk to us about where the business is from that standpoint and what the levers are to help improve the capital efficiency.
Yeah, certainly. So the ideal state is to get to balance sheet light, right? Where you can originate an $100,000 advance in the morning and the coffee shop agrees to pay you back $113,000 over the next 12 months. So now you have a $113,000 receivable and you can turn around and sell it in the afternoon for 106. So you can book a 6-point gain on sale or $6,000 gain on sale on every dollar you deploy. That's the balance sheet light. We're not a bank. We're not holding a bunch on balance sheet type of setup. And that's where Pipe is going to get to. You need 12 to 18 months of completed vintages to get to a completed vintage. You need 5 or 6 of those, right? So you need almost 2 years of history if they're all performing perfectly to get to a place where a capital markets, like where I used to work, will lean in and buy that risk from you and take all of the risk. You don't have to be distressed. New York Life Insurance is buying some of this from people I know. It's if you can get it rated in the background from a Kroll, the insurance companies buy directly. The pension funds buy directly. They're getting a 10% IRR, unbelievable risk because it's structurally senior from a cash flow perspective. And so there's enormous demand. If you have the right history, you can actually sell this stuff to insurance companies and pension funds directly. The big banks are buyers. Yes, some of the funds are also still buying because they can lever it up. They get a 10 IRR unlevered and they can lever it up to get a 15% return on their money. So they will take that risk all day long because it's idiosyncratic from the other stuff they're investing in. And so that's the end state goal. You just have to have 2 years of history to get there. So we're a few months short of getting to the place where we can just sell whole, do forward flow agreements and sell whole loans. In the phase before you get to that point, you have to have capital to deploy. We have $400 million in balance sheet in 2 different warehouse facilities that let us deploy capital in a very high advance rate scenario where we don't have to put much equity in and we can still scale. So we could do $1.2 billion in annual volume with the warehouses we have. By the time we fill that up, which will be soon, we'll be able to sell whole loans. We'll be able to sell whole loans or do forward flow agreements, and then you have unlimited scale. This is a balancing act for any lender, to get to the point where you are not eating up too much equity as you scale in your warehouses to then get to the place where you can sell whole loans. That's the dance. And that's why you need $200 million to start with to make it happen. Right? You can't do it with 10, or 15 because you'll have to raise money in the interim or figure out like most of your equity will end up in your warehouses and you're out of money. That's the problem with some of these businesses. They just get out over their skis and need too much equity in the warehouse and it doesn't work, right? The road is littered with the bodies of people who tried and failed to do this. And that's why you need so much in your cash to actually get through and make it happen. And when you can't make any mistakes either. That's the thing.
In the whole loan sale example, are you not taking any risk at that point? There's some sort of first loss coverage or nothing?
Nope. That's it. You originate $100,000 advance. The customer agrees to pay you back $113, and you're selling that $113 cash flow for $106, and then all the cash flows go to the buyer. That's it. If there's fraud, yes, there may be like for first payment default or other stuff, then those don't count, and so you pull those back. The reason the fraud is so low here because the business has been using that vertical software for 6 months. You can't fake that. Right. It's not low hanging fruit to go create fake credit card transactions into a fake business for 6 months and not get caught with chargebacks or whatever else. The only real fraud risk is account takeover risk. And if you're very careful with the bank account on file and making sure the money's not going to a bank account that has been changed by some bad guy, you're pretty safe. Sometimes the internal like bad guy inside the business, it's like stealing from the business owner and has access to the software. You'll see every once in a while a case like that. It lessens the risk to partner with the sticky vertical software. That's the other beauty of this. Because you're doing B to B to B and you're partnering with big Bs that are just as sticky as Square, like you get the same benefit.
When you're getting to this point of selling the whole loans, you'd be selling them into a dedicated facility or like allocated capacity in some way, like structured or packaged prior to the on sale to the markets? Or how would it work?
At Square, we had I'll make up numbers, like 10 buyers that each of them in staggered saying, I'm going to buy $5 million a month for the next 12 months, as long as it fits in this box. And then next month you find another buyer that's willing to do 5 million. So you have the staggered set of whole, like you always have like 9 to 12 months of commitment ahead of you, even on the whole loan sale side. They're just buying it. Some of them will turn around and securitize it. Some of them will turn around and put it into a closed-in fund like retail vehicle or put insurance money behind it. Every buyer can do whatever they want with it. It's a cash flow stream that they just bought that has a return on it, and they can, whatever financial engineering they want to do behind the scenes, they can. But from Pipe's perspective, we just sold it and they can do whatever they want with it. Yes, some of them may securitize, sure, but it doesn't matter to me. We're still servicing it and handling the customer contacts and information. We're just passing the cash flow onto the buyer of that asset.
Got it. So to your point about, you can't mess anything up along the way, and I assume one of the primary things you could potentially mess up would be credit risk, especially in changing market conditions. How are you guys thinking about things now? I mean, we're in the midst of market turmoil. There have been on again, off again. I don't know to what impact the average local yoga studio, but you have a broad range of customers in different geographies, no longer like a smooth sailing type environment. How do you think about running your credit business in this environment? What impacts does it have?
So the structure of the product is a massive benefit here, right? So if you are Funding Circle and you're making 3 and 5 year term loans, if you make a 5-year term loan and say, I'm going to wait over 5 years, I'm going to get paid back, something could happen 3 years from now that could still wipe you out. Our product is 12-month term or 6-month term and fully amortizing. So it means that the weighted average life is only 4.5 months. So the whole portfolio turns over in 5 months. You can change your risk pattern so quickly, it helps a lot, right? So here's an example from Square. Consumer discretionary spending, like I'm watching that like a hawk, and so is my credit team. With consumer discretionary spending going down, people will first stop spending money on donuts, and then they're going to stop spending money at the bakery, and then they're going to stop spending money on restaurants, and then after that, maybe coffee. You think like it's just this like pattern happened twice, right? And maybe different next time, but you start to see these signals of from March this year to March last year, are people spending less money on average than in that month than they did the last year in the same. And so if you see it happening, you can assume it's going to be down 5 or 10. Let's just say it's going to be down 10%. The next day, you can change your policy to say, you know what? Like when I thought that all of our restaurants are going to have $1 million in revenue next year, the macro data says it's really only going to be 900,000, right? So instead of letting them borrow 100,000 and getting paid back in like 13 months, I'll dial it down to 90,000 each of them. So you just shrink the loan amount to end up with the same term based on what you think the macro says about future cash flows. So you can actually just turn the dial every week if you want to lower size as you see data coming down, and you bring the vintages back into line ridiculously fast. Right. So that type of protection is huge. You can also, like, nail salons are pretty much recession resistant or recession proof. Plumbers and electricians, if you have a big allocation there, for example, you're not going to wait to fix your toilet, right? Like, that's something that just is going to happen. Like, that maintenance work will continue to happen. If your lights aren't working, you're going to have them fixed by an electrician. And so that stuff's just very recession resistant. Yes, there's some consumer discretionary stuff. COVID is a weird example of like the end of the world for physical retail, but the most amazing thing ever for e-commerce. And so having a portfolio that's distributed across all of these things means that if weird things happen in different pockets, or there's a flood in Houston, you don't have too much allocation there. So it's all about diversification of portfolio across industry, across geography, and just having your hands on the dials to make sure it all travels through well. And because the product is so short, you can just adjust quickly. It's like like it would be the only one I would feel very comfortable with going into a recession. If I had 5-year term loans, I'd be panicking right now. Like, you don't know what's happening. You don't know what's going to come.
So those dials you mentioned, those can be turned at the sector level, the geography, graphical level, right? How kind of nuanced is that modeling?
We have amazing machine learning engineering teams that are cutting the data every way you could possibly imagine. And if you see pockets that are not performing well, you want to understand why, and you reduce the risk in those categories. The macro data, there's known correlations between consumer discretionary going down in certain industries. The grizzled credit veterans we have just know that stuff and start to adjust ahead of it. And so everything you can possibly imagine, like industry, geo, global geo, however else you want to cut it, term, like size of small business. We don't pull FICO score yet, but we may have an upmarket product that will actually pull FICO at some point. And you start using that data as well. But it's every way you can imagine is the answer. And you turn the dial where you see risk, where you anticipate risk is the best way to do it.
As you're thinking about building your business, I imagine there's some level of overlaying the way that the market values businesses in the fintech or financial services space. And in terms of credit businesses specifically, I think this kind of comes down to some of the points you're making before about how capital light you are, how much of your own balance sheet you're using. But if you look back to some of the market price points, valuations, OnDeck is kind of the one that maybe comes to mind, which just for those who aren't experienced credit folks, just seemed like a strangely horrible outcome from a valuation standpoint. How do you think about the trajectory that you're on, building the business that you're on, and also like creating enterprise value that will be perceived by the market?
I think that the ultimate goal is to have diversified revenue streams. You can make so much money with capital because it's the lifetime value is the highest product, right? But we Glean AI, who we just bought, funny enough, you mentioned OnDeck because Howard Katzenberg is the founder of that, and he was the CFO at OnDeck, right? Like, so I can ask him after this, I guess, what his thoughts are on it. But fundamentally, we'll have balance sheet light style revenue coming in from the capital offering. The math is easy. If you're at 40% loans receivable as compared to tangible assets on book, you are a bank and you are going to get a bank multiple. We used to bid on banks at 2 times book back in the day, or even cheaper than that, 1 times book if they're in trouble. Like that is not anything a VC wants to do. That's not what we want to build either. So for Pipe, it's you have to get to balance sheet light. You still keep balance sheet to break even if the market turns. You want that committed capital to be safe and continue to deploy and help your customers, right? Because we're not going to get deposits directly. We're not going to be a bank. I have strong thoughts about why Square might not want to own a bank. That bank was in my P&L at Square, and we had 117 people in it. It slowed us down. And so I think fundamentally you get to a place where if you dial it in, where maximum you can get to maybe 20% loans receivable as compared to tangible assets on book, but you really want to be down to close to 15 or 10. And if you have SaaS revenue, so the Glean has SaaS paying customers on the AP product, right? In the up mid-market. We're working on AI agents right now for our internal use cases that I think we can sell as SaaS products to banks once we put the right compliance wrappers on it. So there's a future where Pipe really is monetizing through multiple SaaS channels, plus transaction, like balance sheet light transaction stuff on the credit risk side, tons of transaction stuff on card and spend management, tons of float from a bill pay and a payroll business, that you can put those deposits back into the banks that you're partnered with to then give you capital discounts. There's ways to recreate stuff with all this. So Pipe should not be considered a capital business. Like, that's just a monetization lever for us to build all the other stuff. Like, there's a future where the embedded financial services are being embedded directly into AI agents, right? And SaaS vertical is going to, like, they will do it themselves too. They'll start replacing some of their own vertical software with their own AI agents to make it even easier for their customers. So there's a world someday where the embedded financial services goes directly to AI agents, which it's going to be here in 5 to 10 years. It's crazy to think about, but that's the world. Like, Pipe is not going to be a bank. Pipe is going to be adding value to small business customers and monetizing through multiple different ways, not all of which are capital or risk oriented, right? So like, that you have to be multi-product and scaling fast, right?
What would an example of actually, we'll come back to that question. So that would basically mean, if you're talking about the valuation of a company, that you're not viewed as price to book because you're not capital intensive, balance sheet based lending business. You are effectively like layering in one revenue stream diversification, and each one, could potentially benefit from different valuation metrics, as well as basically SaaS, i.e. technology company type positioning. Is that the point?
100%, right? If we, so like, think about this from an AI agent perspective. Let's just talk about this part. Most people that, like, a lot of startups saying, I'm going to build AI agents for everything. And any smart VC will say, you need to narrow to one industry, and you need to pick one specific problem within that one specific industry to go solve that pain point first. And then maybe you can earn the right to go do more from there. You need a wedge, right? The beauty, like, we have our own AI stack to like productionalize to help build AI agents already. We're a single industry. So we're eating our own dog food here. Like, we are financial services. We have sales. We have KYC, KYB onboarding, we have collections, we have customer success and collections. Like, each of those could be a different AI agent. The power of the agents, everybody benefits from the same underlying LLMs now, right? Like, we're building it to swap out the best one to make sure it does the right thing. The app layer on top, where my sales leader, Fredo, can manage a team of humans alongside a team of AI agents, and has, like, the compliance team could sit alongside him and has 3 lines of defense from a compliance perspective to make sure the agent isn't saying something it's not supposed to. It can't say, hey, take the advance, you don't have to pay us back. Like, if your agent starts to say that, that's a problem from an FTC and UDAP perspective. So the value add layer that Pipe can build on top of the widely available LLMs that are amazing is the app layer for the humans to monitor and manage and control from a compliance perspective. You build it right in a bulletproof way and it's tested, Bank of America would be happy to buy that and say, hey, I'd love to buy that module because I don't have to know how to use OpenAI. We can just take your sales agent as a service and just the right policies into it, train it on the internal recorded calls, and then it could just be effectively an employee that sits on the desk making calls for Bank of America. And that could be a 10 cents per call or $2 per call type of thing. Yes, there's a lot of startups going after call center type stuff, but because financial services is so complicated, we believe that Pipe has an advantage to go after that space. Like, we're going to do it for ourselves internally anyways. If we get it buttoned up enough, we could sell it as a SaaS product. Right. And that could be an enormous business. That's just very different than the small, but it's an enterprise focused business selling software into other banks because we built the tools for our own use case that is the same as the enterprise use case. Right. That's the basic idea.
Got it. How do you think about market size? I mean, you talked about this transition over the past handful of years now toward vertical SaaS solutions. In your experience, what part of GDP, or at least the sort of micro business economy, is powered by these sorts of vertical SaaS solutions that you can potentially partner with and distribute through versus aren't?
It's tiny right now, is the honest answer. Like, most businesses are still using like Heartland to run their payments, old school POS terminals, and like have an ISO that's selling them the next thing and trying to convince them to switch to the other payment provider. Not using real software, like maybe exports data into QuickBooks when the accountant tells them to do it at the end of the day. I don't like it changes so fast. The growth of when we land a partner without even adding new partners, we're getting 50 to 100% growth because our partners are growing so fast. Like, they are rapidly convincing people to switch away from these old systems, like ISO driven systems, into these problem solving tool or pain point solving tools that are verticalized. So, like, we're just at the very beginning of this. So Pipe gets to ride that tailwind of the transition into vertical. Plus, we add one big partner that has 500,000 small business customers, that can add 50 million in revenue for Pipe and one partner. And then that partner is also scaling at 50. So the growth can be 5x per year if you're adding enough partners each year. Right now, like riding that wave is fantastic because it hasn't really penetrated that much. Every time you look at the research, it's 40% growth or 25% growth. And it's going to keep going for the next 20 years, right? Until it's 70% of the market. It's just going to take a long time to get there, but it's happening fast.
Yeah. Final question, or maybe topic as we wrap up. So you mentioned the geographic expansion. Excited to hear more about that. But kind of in that context, you basically completely repositioned the business since you took over. You have launched multiple new products since then. You just made this acquisition. You're launching new countries. And this is not some sort of like pure SaaS type business you're running here. This is ultimately financial infrastructure. And I imagine there's a ton of connectivity. You mentioned bank partners on the back end. Like having done it myself, this is not the sort of thing you do in a couple of weeks. How are you able to structure the business to move as quickly as you are?
After living it at Intuit and living it at Square, like I'll use Square as the example. We had a 10-year-old Ruby monolith that was the servicing system and the core Square banking system that you couldn't do anything different. Would take 18 months to launch in a new geo because we didn't even have currency in there the right way, right? Like you end up with these old systems that are just awful. And so like you get bogged down and it's almost impossible. Intuit couldn't launch in new geos very well either. You just have legacy systems that slow you down. Coming to Pipe, like knowing what product we wanted and picking a product that is not a loan. Let's just say that it's a cash advance product. And so when you go into a new geo, regulatorily, you worry about money movement and KYC, KYB, like BSA policy stuff, like anti-money laundering, making sure you're not like serving bad guys. So if you take the lending regulatory risk out and have a cash advance, it makes it way easier to go faster. So if your problems are money movement and KYC, KYB, when we kind of started here again at Pipe, we picked Alloy for KYC, KYB. It's an orchestration layer. We started with Modern Treasury to move money. We used Modern Treasury at Cash App. So I just told the team, like, we're going to go build this thing. You can use Peach, Loan Pro, or Canopy to do servicing. You pick which one you want. You can take Alloy off the shelf or use somebody else. There's some other startups doing it too that are pretty good. And then for money movement, here's my recommendation. So then you end up building the experience and an orchestration layer, right? And so these modules, the money movement modules. So here's the example. When we went into the UK, we launched in the UK with Go Cardless. They were our first partner. We launched. They have 80,000 small business customers. It took us 6 weeks to launch in the UK because Alloy already worked there. All we did was swap the data sets out, almost the same rules. It let us go very fast on the KYC, KYB part. So the money movement folks were very comfortable moving money with us because we had the right compliance layer on the AML and like terrorist watch list side. And then Modern Treasury didn't work great there. So we swapped in AirWallex and Go Cardless to do money out, money in. And when you built it in a modular way, you can swap the modules and go faster. So I think Angela Strange at some point described fintech as like fintech modules. We're living it right now. To be able to take these like partners that do big parts of this business off the shelf, but like really our expertise is in capital and design and experiences and solving pain points. If you can find a card issuer that can issue cards in 50 markets, and they exist now, then it unlocks our ability to go super fast. Like launching in the UK with Square debit card, we were already using Marqeta, we're kind of tied to them. It took us like 12 months, even with an existing partner. And so like just slow. But now that there's new modern card issuing partners that are in 40 geos now, will be in 80 geos soon. We can be the one-stop shop for a mega cap platform that wants to do capital, card issuing, and bill pay spend management, all this money movement stuff. If you wanted to do 10 geos before as a big mega cap company, you'd need 30 partners and you'd need massive engineering teams and you need a biz dev team that would like say, I can't do that. I cannot, even if you give me 30 more employees, I can't launch 30 different products in 10 geos at once. It's insane. But if you have a partner like Pipe, that has the modules underneath you, like underneath them, that can go super fast and just has the thing built in the right way, then you actually can go do 10 geos at once with 3 products because the systems are just better now. Like that's why fintech is so much better. Even 5 years ago, Alloy couldn't have done what we wanted to do at Intuit, but it can now. AirWallex can issue cards in 40 geos. The risk part is the hard part, and that's our core advantage. We still use these modules to go do, and we can create these magical, consistent experiences across multiple geos for these mega cap platforms and make them heroes because they could do 10 geos at once. And they never could do that before, right?
You replicated the FBO structure in the UK also? You needed a local partner bank or one of the fintech partners?
We are only doing the core capital structure right now in the UK. So that's the other playbook, right? With Square, the same playbook at Pipe. You take the core product that works the best, capital. It is the easiest to go into new geos. So that's the one that leads. When you have 50 to 100,000 underlying small business customers, then it's worth it to turn on the next product. And so card will go first in the US with accounts payable solutions, and then UK is probably next, and then Canada, and then Australia, then Japan, France, Spain, Germany. But it's going to be one market at a time once those markets get to the size that it makes sense to spend the resources on. And then after you've taken the existing products to all these geos, you either go up market, and we may come after Brex and Ramp at some point because we already have a mid-market AP solution. The risk on card by just underwriting with cash in the bank account is way easier. So we have an option to go up market now too, and we'll do that when we need to.
Awesome. Luke, really appreciate all of the insight in this, what felt like sort of rapid fire Q&A. You're a fast thinker and a great communicator. I really appreciate the time and the great conversation.
I hope it was all understandable, or you can at least slow it, put it on 0.75 speed if I'm talking too fast. Oh, well.
Absolutely. Luke Voiles, thank you very much for joining us today.
Thank you. It was fun. Love talking about this stuff.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.